Ron Paul on the fall of the US dollar as reserve currency. It's always longer than some predictions. Ron Paul, a former US representative and member of the Libertarian Party, has addressed recent events directed to undermine the influence of the US dollar as a reserve currency in international markets. Paul believes that even if this does happen, it will probably take more time than some predictions are saying. In the latest edition of his online webcast, The Ron Paul Liberty Report, former United States
presidential candidate Dr. Ron Paul. Welcome, Dr. Paul, to Futures Now.
Thank you. Nice to be with you.
Now, you've suggested that central bankers around the world, what they're doing is irresponsible and will cause chaos. Can you quantify what that means for the market?
Well, I can't tell you exactly how bad it's going to get, but it's going to get bad because we've never been here before. Our predictions don't mean a whole lot when we've never had as many currencies in negative interest rates. $17 trillion worth of bonds, negative interest rates. It's never existed before. And that's a bubble. And so we're in the biggest bond bubble in history, and it's going to burst. And people say, well, we have no inflation. And I argue we have a ton of inflation. We have all that QE. And every time you lower interest rates below market levels and create new credit, that's a bubble. That's inflation. Sometimes it goes into buying goods and services, but sometimes it goes into buying securities, sometimes stock market, sometimes plain old bonds. But the big bubbles in the bonds, it won't last. It can't work this way, and we will do some catching up. I'm sure we will join the rest of them and go to total negative rates in hopes that that'll be the solution. I can remember just a few years ago they were on Greenspan's case because he kept interest rates too low for too long, 2 or 3%, and he caused all this trouble. And now everybody's in negative. So we treated the complaint about Greenspan by super inflation of the monetary system and drastically lower interest rates, which destroys the pricing mechanism in financial markets.
But if this trend continues, Dr. Paul, I guess the question is when? When will the bond bubble burst? What kind of timeline are you working with here?
Well, people ask me all that, and I follow the rules that I've studied and learned in Austrian economics, as you know trends, but you don't know timing. If you did, all Austrian economists would be the wealthiest people in the world. It's unknown. The surprises come. There were a few surprises in '08 and the Lehman Brothers and the collapse there, which I still think partially we're still suffering from. No, you don't know the precise time, but you know it can happen with the inflation. If you know the inflation distortion, if you haven't had market interest rates, you're going to have a lot of malinvestment and bad debt. And I think when you look at the bond market, you can argue there's a bad debt. How do you sell a bond that pays a negative rate? Who's going to jump up and down? I don't understand the markets completely, but it seems to me that wouldn't be a very attractive purchase. And there's $17 trillion out there with negative rates. It's such a mixed deal. And on the euphoria, see, I think the thing that's worked so well is the plunge protection team. The whole purpose of the Federal Reserve is to prop up the stock market, and Trump is not happy, and yet he should be their best friend because look at what the Fed does, and they try to maintain a semblance of normalcy. But believe me, this is not normal, and the Federal Reserve really works hard, along with some other agencies of government, to prop up the stock market. And I think they've done pretty well because I could find a lot of negative news which suggests, hey, this is bad trouble for the world financial system.
Dr. Paul, it's Anthony in New York. With all due respect, sir, you've said this a lot before, that there's going to be this collapse. And over the last 5 or 6 years, the market has been pretty good. So the U.S. is the reserve currency of the world. It looks like our equities market is the reserve equities market of the world, and our bond market might be the reserve bond market of the world. So doesn't those factors insulate us from the disaster that you're talking about?
Oh, it protects you temporarily, but it's never worked before. It's not. It doesn't work that way, where you can use illegitimate bond creation as the reserve currency of the world. What you really should be concerned about is the competition that's brewing out there to replace the dollar, and that's why we get away with this. We print the money, they keep it in reserves, and we get to spend more.
Yeah, but with
debt
all due respect, sir, the euro's a mess right now. The euro's a mess. The pound isn't going to replace the dollar at this point. So what else is there to replace the dollar?
Well, I would think you'd look toward the Far East, look toward Russia and China and India. People are very angry with us the way we throw around sanctions and tariffs and how we can badger people because we control the financial system. And a lot of people don't like our foreign policy. And so when this thing starts to crack, yes.
Dr. Paul, it's Jim Urio. A quick question. You mentioned bubble. You said it. You described bonds bubble. We've seen two bubbles in our lifetime: tech stocks and real estate, and both of those were characterized by the type of leverage, mom and pop leverage at the end, borrowing and going all in. That's clearly not the case in bonds. So when it pops, could it be different and less aggressive as those other two, or will it be more so?
I think it's more so because maybe the mom and pops don't have to do it. Maybe it just has to be central banks and big corporations and private entities. This is the one thing about Austrian economics. You can't predict exactly where the creation of credit goes. And all we have is fiat monies around the world, and you can't predict where it's going to go. But comparing our dollar and say, well, our dollar's great compared to the euro, of course it is, because we have a military might, we control the financial markets, and it's still a wealthy country, so we're looking good, and as long as we can still print money, but confidence will be lost. There's a bit of confidence still in our system, but I think it's fragile. And time will tell. I'm not saying next week you're going to see it, but I'll tell you what, when you do have an end point on these bubbles, especially this one, which has never been witnessed before and experienced, I don't think anything ever existed even coming close to what we're facing today.
Some interesting views you've brought to us here on Futures Now. We appreciate you joining us today, Dr. Paul.
Hey, thank you. Nice to be with you.
Anthony, how are you trading the 10-year here?
D's 10-year, I'm a buyer right now. 129.20 is where I'm buying the D's 10-year. I put in my stop in at 129.10. I'm looking for a move to 130.20. I think the Fed follows suit with the ECB, even though I think that they shouldn't do it or that there's no reason to do it. I also think that our interest rates look very attractive at 1.5% versus the negative rates in Europe, and we're on support. That's why I'm buying it.
Yeah, Jim, we're off the lows of the month now.
No doubt. And I don't I'm the other way. I think that the stock market's going to rally and the curve's going to steepen out a little bit, and the market's going to look at the Fed and say the Fed is doing enough or has done enough, and that's going to allow the curve to steepen a little bit. So I'm more of a seller of the 10-year, but it's not a high conviction trade on my part either. So I'm only going to say